Hey traders, Raghee here. We're going to talk about day trading indicators. Day trading meaning a style of trading where we are flat at the end of the day. How we look at a day trading day really has a lot to do with the way that we use the indicators that are on our chart. So let's start off with the basics. Right now, I'm taking a look at a 5-minute chart of the S&P. That means each one of these candles represents the open, the high, the low, and the close that takes place over the course of 5 minutes. Indicators, most indicators, take those prices, the open, high, low, close, and through some sort of addition, subtraction, multiplication, division, spits out some sort of indicator. Now, indicators can measure price in the case of, say, a moving average, or in the case of using different types of support and resistance. And it gives us an idea, it gives us day traders an idea of the kind of environment that we're dealing with. Is a market going lower? Is a market going higher? Maybe it's not going anywhere at all. So rather than just looking at the open, high, low, close, we let an indicator decode what's happening within these 5-minute or 2-minute or 1-minute charts, okay? So again, the idea is to let the indicators take price and give us a little bit more insight into what's happening. What I have found over 30 plus years of trading is that there really are 4 different things that we measure as day traders, and therefore our indicators should also reflect that. We can, of course, measure price, meaning that I'm going to take a look at support and resistance, perhaps moving averages, and that's where most traders stop. The next thing we need to look at as day traders is time. Because if we're taking a look at, for example, the Wall Street Open, 9:30 a.m. Eastern to 4 p.m. Eastern, we're looking at a very specific set of time, and there are behaviors that are mechanical, almost mechanical habits throughout the day. Lunchtime, the open, the close. There are bond closes to contend with. There are economic releases to contend with. There are scheduled speeches from FOMC members. So time is often a very overlooked indicator. And yes, I do think time is an indicator. And time also overlaps with the other 2 factors. So we've talked about price. We've talked about time. Now we're going to get to volume. Most traders look at volume. And by the way, what is volume? Volume is the question that answers how many contracts were traded at a specific time of day. That's the most common type of volume, time-based volume. But the kind of volume that I recommend day traders focus on is actually much more uncommon. And that is price-based volume. So rather than focus on how many contracts were traded at, say, 9:55 a.m., we want to know how many contracts traded at, say, 44:05. How many contracts were traded at a specific price. This is also known as volume profile. Now, volume can be measured through a number of tools. My favorite is the anchored volume-weighted average price. Think of a moving average where rather than prioritizing price, we're prioritizing volume. It's also known as a VWAP. What's unusual about the way that I use a VWAP is that we anchor it to a certain price. We don't just let it roll from session to session. And this increases accuracy because we're measuring this volume from a very specific psychology, meaning from, say, the open forward, or say maybe from an economic release forward. We're getting very specific about the time that we're studying this volume. Another really important volume tool is one that I created about 14 years ago, and that is the VSCORE. VSCORE is a Z-score, a standard deviation of the volume-weighted average price. So right back to that indicator that we just talked about that prioritizes volume. Sometimes volume wanders so far away from where the average or the mean is that there's a higher likelihood that it's going to snap back. So the further away we get from home base, the mean, the more likely we are at some point at the extreme extension of that V-score, of this Z-score of the VWAP, which is just a fancy way of talking about the bell curve behavior of anything. We're just doing it to the volume weighted average price. We get too far away from the mean, the market wants to snap back. And that's what this measures. Have we wandered too far away from the mean? Have we wandered too far away from the home base? Very valuable in trading because day trading can be very, very volatile. And volatility can be measured with a Z-score, with when I'm talking about the standard deviation, prioritizing price. This is going to give you an edge over most traders that are just looking at price, because at this point, we've talked about the importance of price, we added time, we added volume, and we've discussed this concept of volatility. That's the fourth factor. How do we measure volatility? What is volatility? Volatility is just the high-low range of price that any indicator can actually, any market can go throughout the span of a month, a day, or in the case of day trading, a single session. In other words, when we're taking a look at the S&P, we know that the volatility right after the bell is quite high. That's known as the clearing range, and we know there's a flood of orders that hit the market when the Wall Street bell rings. Volatility is that high to low range that we get. Now, what if I told you it was actually kind of a predictable, almost predictable, if not sort of a routine thing? In other words, going back to time, we know that at certain times of day, there's more attention. The very beginning of the day, the very end of the day. But what if furthermore I said there's a measuring stick that we can put on volatility, that there is a typical number of points that the S&P or crude oil or Amazon or Tesla or Apple tend to move from hour to hour. This volatility can be measured, and this is another tool that I created. It's called the hourly price movement range. That means every hour there is a price movement range that I am studying. And it helps us forecast or project the volatility-based support and resistance for the market for that hour, hence hourly price movement range. Again, what we're now into is 4 factors deep into intraday action. So most traders, they're looking at open, high, low, close, maybe a couple support and resistance levels, maybe some moving averages, all price-based. We then move to time. We know that if the FOMC has a meeting, if there's a speech, if we have non-farm payroll, if there is a decision, a rate decision, we know that time is another factor we need to think about when it comes to our trades. Volatility is very much related to time. Certain times of day are going to be more or less volatile. So traders are vulnerable to sudden expansions of volatility. They're also vulnerable to sudden contractions of volatility. If we know there's a rhythm to that and we plot support and resistance according to that, once again, that gives us a tremendous edge on traders who are still just focused on price and not time and volume and volatility. The HPMR is perfectly designed to allow us to see hour by hour what the typical price movement range is, plots of resistance, plots support. Now, one thing I want to mention, everything we've talked about so far really does boil down to answering where is the support and resistance in the market. Of course, price is the easiest way to do that, but volume based on price is another way to decode where support and resistance is. You add time. Well, if I know that the market is going to be dealing with a very volatile event and that event creates a new high or a new low, there's another way to understand sort of the extremes of emotion, the extremes of psychology, and support and resistance gets put in based on that time. And finally, there's volatility. So rather than the events that can occur based on the economic calendar, now we're talking about sort of the routine, the daily routine the market tends to go through, a little bit more of a predictable support and resistance based on volatility. You put all these 4 factors together with these indicators, you're going to have an edge. Every one of the indicators on my screen is designed to take advantage of one of those 4 factors. So I have grab candles, GRAB, which is really a price-based indicator, which allows me to understand the sentiment, the momentum, and the trend based on the color of the candle. Red is bearish, blue is neutral, green is bullish, right? We also have some moving averages that are related to the grab. The moving averages are the 34-period exponential moving average on the high-low close. The grab candles color according to price's relationship to the moving averages. All right, so those are 2 price-based tools. Now come our volume tools. The VSCORE, have we wandered too far away from the mean? And the anchored VWAPs. What are the moving averages, if you will, that are based on volume and not price? All right, then we can move on to volatility. Those are our hourly price movement ranges, forecasting the support and resistance based on time and on volatility. Volatility changes hour to hour throughout the day. And of course, you can see time sort of strings through all of this. Time of day, time of economic releases, time of day affecting volatility. So you tie all those together and you have indicators that measure each one of those. Now you've got a full view, a comprehensive view of the market, because you're not sitting in a one-dimensional price-based view of day trading action. Now you're 4D. You have a 4-dimensional view of the action, and much less is going to surprise you because you're prepared for all the different types of action that the market can present. Hey traders, Raghee from Simpler Trading. Thank you so much for watching this video. Be sure to leave a like and a comment below. And remember, subscribe and click the bell icon so you'll get notified of the next update. And when you're ready to join me for live trading, be sure to head on over to simplertrading.com. I'll see you in the next update.